Credit cards have become such an integral part of our daily lives that it's easy to take them for granted. We use them to pay for everything from groceries to vacations, and we've become so accustomed to swiping or tapping our cards that we may not even think about how they work or where they came from. But credit cards didn't just appear out of nowhere. They have a history, one that dates back to the earliest forms of borrowing and lending. In fact, the concept of credit is as old as civilization itself. People have been borrowing and lending money for thousands of years, and over time, this has evolved into the complex financial systems we have today. In this video, we'll explore the origins of credit cards, from the earliest forms of credit to the introduction of charge plates and the rise of modern credit card systems. We'll examine the role that banks and other financial institutions played in the development of credit cards, as well as the impact that credit cards have had on our economy and society as a whole. By understanding how credit cards evolved over time, we can gain a deeper appreciation for the role they play in our lives today, and perhaps even begin to imagine what the future of credit might look like. So, let's get started and take a journey through the fascinating history of credit cards, from their humble beginnings to their present-day ubiquity. Part 1. The Beginnings of Credit. As we mentioned in the introduction, credit has been around for centuries. In ancient times, people would often borrow goods or money from each other on the basis of trust and reputation. These early forms of credit were based on personal relationships and were often used by merchants and traders to finance their businesses. Over time, as trade and commerce grew more complex, these personal relationships became less reliable. Borrowers needed a way to prove their creditworthiness, while lenders needed a way to keep track of who owed them money. This led to the emergence of written credit agreements, such as loans and promissory notes. One of the earliest recorded examples of a written credit agreement dates back to ancient Babylon, where merchants would use clay tablets to record loans and debts. These tablets served as a kind of early ledger, allowing lenders to keep track of who owed them money and how much they were owed. In ancient Greece and Rome, lending was often done by wealthy individuals or families who would loan money to those in need in exchange for interest. These loans were typically secured by collateral, such as property or goods, and were often used to finance large-scale projects or ventures. During the Middle Ages, the Catholic Church played a significant role in the development of credit. The Church prohibited the charging of interest on loans, so lenders developed alternative forms of lending, such as charging fees for the use of money or goods. In the 16th and 17th centuries, modern banking began to emerge, with the establishment of banks such as the Bank of Amsterdam and the Bank of England. These banks issued paper notes that could be used as a form of payment, and they also provided loans to governments and businesses. The development of banking and credit continued to evolve throughout the 19th and early 20th centuries with the introduction of checkbooks and the widespread use of loans and credit agreements. However, it wasn't until the 20th century that credit cards as we know them today began to emerge. Part 2. Charge plates. Now, we'll take a closer look at one of the earliest forms of credit cards, the charge plate. Charge plates were small metal plates, about the size of a credit card, that merchants would give to their customers to use for purchases. Each plate had the customer's name and account number engraved on it, along with the name of the merchant. When a customer made a purchase, the merchant would use a small machine to imprint the details of the sale onto a piece of paper, which was then attached to the charge plate. At the end of the month, the customer would receive a bill for all of their charges, which they could then pay off in full or in part. The use of charge plates dates back to the late 19th century, when they were first used by hotels and department stores to keep track of their customers' purchases. By the early 20th century, charge plates had become more widespread and were used by a variety of merchants, including gas stations, restaurants, and even dentists. One of the main advantages of charge plates was that they allowed merchants to extend credit to their customers without having to worry about the risk of non-payment. Because the customer's name and account number were engraved on the plate, the merchant had a way to track who owed them money and could take steps to collect any outstanding debts. However, charge plates were not without their drawbacks. For one thing, they were limited to use at a specific merchant, which meant that customers had to carry multiple plates if they wanted to shop at different stores. Additionally, the process of imprinting the details of each sale onto a piece of paper was time-consuming and labor-intensive, which made it difficult for merchants to keep up with high volumes of transactions. Despite these limitations, charge plates remained a popular form of credit throughout the first half of the 20th century. However, their days were numbered, thanks to the invention of a new technology, the magnetic stripe. Part 3. The Diners Club. In the previous chapter, we explored the history of charge plates and how they were used by merchants to extend credit to their customers. Now, we'll take a closer look at the development of the first modern credit card, the Diners Club card. The Diners Club card was invented in 1949 by Frank McNamara, a businessman who found himself without cash one evening while dining out with clients. Embarrassed by the situation, McNamara vowed to create a way for people to pay for their meals without carrying cash. The first Diners Club card was a charge card, similar to a charge plate, but with some important differences. Unlike a charge plate, which could only be used at a single merchant, the Diners Club card could be used at multiple locations, including restaurants, hotels, and travel agencies. In addition, the Diners Club card was not tied to a specific merchant, but rather to a network of merchants who accepted the card. This made it more convenient for cardholders who could use their card at a variety of different locations without having to carry multiple charge plates. To encourage merchants to accept the Diners Club card, McNamara offered them a small percentage of each transaction as a fee. This fee was paid by Diners Club, not the merchant, and it helped to incentivize merchants to sign up for the network. The Diners Club card was an immediate success, and within a year, it had more than 20,000 cardholders. By 1952, the card was accepted at more than 10,000 locations in the United States and abroad. One of the keys to the success of the Diners Club card was its exclusivity. In the early days, the card was only available to a select group of high-income individuals, and it was marketed as a way for them to enjoy the finer things in life without having to carry cash. This exclusivity helped to create a sense of prestige around the Diners Club card, and it helped to attract a high-profile clientele. In the early years, cardholders included celebrities like Frank Sinatra and Elizabeth Taylor, as well as business leaders and politicians. The success of the Diners Club card paved the way for the development of other credit cards, and within a few years, a number of competitors had entered the market. These included American Express, which launched its own charge card in 1958, and Bank of America, which introduced the first true credit card in 1959. Part 4. Bank AmeriCard. In the previous chapter, we learned about the success of the Diners Club card and how it paved the way for other credit cards to enter the market. In this chapter, we'll focus on Bank AmeriCard, which later became Visa, and its impact on the credit card industry. Bank of America began issuing Bank AmeriCard in 1958 as a rival to the Diners Club card. Unlike the Diners Club card, Bank AmeriCard was a true credit card, which meant that it allowed cardholders to carry a balance from month to month and pay interest on that balance. Bank AmeriCard was an instant hit, and by 1966, it had more than 3 million cardholders. However, the rapid growth of Bank AmeriCard also presented challenges for the bank. Fraud was a major issue, as criminals began to target the new card for theft and counterfeiting. To address these issues, Bank of America began to license the Bank AmeriCard name to other banks across the United States. These banks were responsible for issuing the cards and managing their own risk, but they also had to adhere to strict rules and regulations set by Bank of America. By the early 1970s, Bank AmeriCard had become so popular that it had outgrown Bank of America's ability to manage it. In 1971, the bank formed a new company, National Bank AmeriCard, Inc., to manage the Bank AmeriCard network. Later that year, National Bank AmeriCard, Inc. changed its name to Visa, and the Bank AmeriCard name was phased out. The new company was a cooperative owned by its member banks, and it was responsible for managing the Visa network and setting rules and regulations for its members. Visa quickly became the dominant player in the credit card industry, and it remains so to this day. Today, Visa has more than 3 billion cards in circulation, and operates in more than 200 countries and territories. One of the keys to Visa's success has been its focus on innovation. Throughout its history, Visa has been at the forefront of new developments in the credit card industry, including the introduction of magnetic stripe technology in the 1970s, the rollout of the first chip-enabled cards in the 1990s, and the development of mobile payments in the 2000s. Visa has also been a pioneer in the area of fraud prevention. The company has invested heavily in technology and analytics to detect and prevent fraudulent transactions, and it has worked closely with law enforcement agencies around the world to bring criminals to justice. In recent years, Visa has also become a leader in the area of financial inclusion. The company has launched initiatives to bring financial services to underserved communities around the world, and it has partnered with governments and non-profits to promote financial literacy and empowerment. In this video, we've explored the forgotten origins of the credit card and the evolution of the credit card industry. We've learned about the beginnings of credit and the emergence of charge plates, which paved the way for the modern credit card. We also learned about the success of Diners Club, which was the first card to offer credit to its members, and how AmeriCard, which later became Visa, changed the game by creating a true credit card that allowed cardholders to carry a balance and pay interest on that balance. We saw how AmeriCard's success led to the creation of Visa, which quickly became the dominant player in the credit card industry and remains so to this day. We also explored some of Visa's key innovations and its focus on fraud prevention and financial inclusion. So what does all of this mean for consumers and businesses today? The credit card has become an essential tool for managing our financial lives, but it's also important to be aware of its potential pitfalls. One of the biggest advantages of using a credit card is convenience. With a credit card, you can make purchases almost anywhere in the world, and you don't have to carry cash or worry about exchange rates. Many credit cards also offer rewards programs that can provide significant benefits to cardholders. However, using a credit card also comes with risks. Those risks include going into severe debt as well as potential for credit card fraud. Despite these risks, the credit card remains a valuable tool for managing our finances. By using credit cards responsibly and paying off balances in full each month, we can take advantage of the convenience and benefits they offer while minimizing the potential downsides. In conclusion, the credit card has come a long way since its humble beginnings as a charge plate in the late 19th century. Today, credit cards are a ubiquitous part of our financial lives, offering convenience and rewards to millions of consumers around the world. While there are risks associated with using credit cards, these risks can be managed by being aware and responsible. As the credit card industry continues to evolve, it will be interesting to see what new innovations and challenges arise in the years to come.